Hello, everyone. My name is Jacob Forton. I'm the host of this podcast, Doers Within Emerging Markets. And I just want to share my experience with using Anchor so far. When the pandemic started, I thought about starting a podcast, and the whole idea was to bring in some really amazing folks that are doing some great work in their respective industries within the emerging markets. And the Anchor platform really helped me get the word out there and also just make it a lot easier for me to invite the guest and just share the amazing experiences they've had and the amazing work they're doing in their respective industries within the emerging markets. Um, it's pretty fun. You don't even worry about the technical part of making a podcast. You actually just focus more on the content. And Anchor has done it really well for me. So I will highly encourage anybody who is trying to start a podcast to try to use. Just check out Anchor, and I think you won't regret it. I'm not a technical person, but if you listen to these episodes that I've been publishing so far, it seems like I know what the technical part of it, but Anchor helps you take care of the technical part, and you just focus on the content. So feel free to check it out. I highly encourage. You won't regret it, and it's right there. You don't pay anything. So in times like this, I think starting a podcast and getting the word out there, irrespective of what you're doing, will be a really great experience. So thank you guys for listening to my episodes. Please check out Anchor, and you will have a great time. So cheers, guys, and see you guys next episode. Thanks.
Do you think? It sounds like having that on the ground experience might have provided you with some incredible insights beyond the papers you read. Do you think, to some aspect, if you had traveled to some other emerging markets, like for example Pakistan or let me say China or all these other like BRIC countries, do you think it might have provided you with some insights that might have maybe
shape the paper a different way?
What do you think?
Absolutely. Yes. I'd say so. Mexico is what we had the opportunity to visit, is where we had the opportunity to visit. And so we immediately seized that opportunity. If we had the opportunity to visit 30 more countries, I would be on those planes, interacting with large scale, small scale businesses. And just I think that would have enriched our views, added some more meat to the bones that we had written on paper, we had read on paper, for sure, because that human interaction, that human perspective, and the history that comes with human experience that could be shared, that's invaluable, and so I think that would have enriched this paper a bit more. And who knows? I mean, I have weighed the idea of building on this paper. And doing some further analysis, and so I will definitely entertain the opportunity to interact with business owners and workers from different countries. And if I have the chance to go to some of these countries, I will certainly take that opportunity. I think so.
Yeah, definitely. I think the paper definitely has. I think it's more of like a platform, because just the indicators provided in the paper and the recommendation that you had would definitely provide you with an opportunity to actually build something on it. So I completely agree with you on that. And just to go into like the different, if you may. So we've talked about like the countries, but I think we haven't talked a lot about the countries providing the FDI. So we've talked about the countries receiving the FDI. What was like? What was the difference? And I mean, in terms of like, do you think the FDIs, based on the time frame that you did the paper on, has shifted now from 2016 to 2020? And can you just give us like
quite frankly, there's very little I can say on that with certainty, just because, well, one, we wouldn't have data on we wouldn't have 2020 data now, and I'm not even sure as of March we have 2019 data yet. at best, maybe 2018 data will be available. And we can check this. We're recording now. Had I known, I would have looked this up. I have my laptop here. We can look it up. But I'll
yeah, sure.
yeah. But what I
we can do another episode.
Right. What I can speak on specifically, because I looked, and before I say that, this paper really didn't pay too much attention to FDI outflows, just because we were looking at the relationship between foreign direct investment and economic growth. So we wanted to see what the relationship will be on the host countries, not on the donor countries, on the recipient countries. And so we didn't do a lot of work, quite frankly, looking at how much is going out in investment. But generally speaking, roughly, for many countries, inflows, many emerging countries, inflows exceed outflows by far. That kind of was the trend we saw with the countries we looked at, except for one country. And what would you guess that country to be?
I would take
yes,
China.
Yes, without a doubt. In fact, in the table, I think on page 7 of the paper, that shows you. It's a very, very stark picture. It blew our minds so much that we had to put it in the paper.
Yes.
So back in 2007, this is just 10 years before the end of the period. 2007, FDI inflows into China were about $156 billion US. This was in 2007. By 2016, FDI inflows into China had ticked up a bit, so about 10 years later, it had gone up to $170 billion. So just a slight tick of about, $14 billion increase over 10 years. When you look at the FDI outflows, so how much China was investing out of China into other countries, at the beginning of the same period, 2007, FDI outflows from China were $17 billion US, 17. So compared to 156 they were receiving in the same year. But by the end of the decade, by 2016, that outflow had jumped from $17 billion to $217 billion. I mean, that's mind blowing. That's several times how much was going out 10 years before. And you also notice that by 2016, FDI outflows from China were exceeding the inflows by quite a lot, by about $47 billion on an annual basis. So that was really mind blowing, and that's a one of a kind trend shift. There are not a lot of China's out there, so
exactly. No, actually, I came through this page, but also why, and I had to grasp this. But for some reason, that table had some essence to why you included on the paper, and I actually agree. China is at this point, at this time frame, it's like there was like a flip. A 10, 11 years difference. 9 years difference
from the beginning of 2007 to the end of 2016.
Yes, exactly. I think that's just, as you said, it's incredible, and just kind of for us to kind of be winding down. So I know you make the case for each continent, and it's pretty evident on the paper based on your findings of some of what you found on each continent. But we saw this China table for the case of Asia, that stood out. What other indicators in the paper, and I know some of it is in the regression analysis that you did, that kind of just you were surprised by it as well?
I'll go to Africa because Africa's home, and
yes, that's what I was hoping. That was what I was hoping to do, but I do want to say it.
Well, Africa's home, and so when you look at the case for Africa, I think we had about 7 countries for Africa. We had Egypt, Ghana, Morocco, Namibia, Nigeria, South Africa, and Zambia. These were the emerging emerging economies that we saw across the African countries that we thought, for two reasons. Again, one, they have seen, or they have demonstrated sustainable growth year over year. No matter how small, it's been pretty stable growth. And also that there was readily available data going back to the period that we wanted, which was from 1987 to 2016, representing 30 years. And so that's kind of how we came upon these 7 countries. But that said, there are other African countries that certainly, especially in recent times, have exhibited tremendous economic improvement that we just didn't study those countries for one reason or another, such as just unavailability of reliable data. But some of those countries were Ethiopia, Ivory Coast, Senegal, and Tanzania. And Quads actually wrote an article in 2018 about these countries. We don't talk about this in the paper, but Rwanda in the last few years has shown tremendous leadership across the continent, leading economic growth, leading in just demonstrating really solid political leadership and stability. So I think that there are countries out there, and if you're an investor, you should take a look at these. Some of the purpose of papers like this is not. It's really to highlight also opportunities that are there in many parts of the world, including the African continent, and to help you make an informed decision, because part of the problem investing in emerging economies is just the unavailability of data.
Exactly.
With the 7 countries, I wouldn't run through the entire table just because no one's really gonna remember that unless you're physically seeing it. But like I'd point out Namibia, for instance, and if you look at Namibia between 1987 and 2016, the percentage change in foreign direct investment was over 88,000%. Yeah,
that was crazy.
So 88,000%, almost 90,000%. I mean, that's just a number that I don't think I've ever said before. 90,000%. But to be fair, some of those numbers are just because a lot of these countries had little to no foreign direct investment back in 1987. So if, say, for instance, you had an entire country and foreign direct investment back in 1987 was $10,000, right? If that number increases to $1 million, for instance, right? Then how many times has that increased? That's $1 million divided by $10,000, and so that kind of throws that percentage change up there. And I think that's the case for a lot of these African countries. It's a good sign. It means that over the years, over the decades, foreign institutions, foreign governments have started to slowly recognize opportunities in African countries that show potential and are putting some of that capital in these businesses in these countries. So that's good, and there's certainly a lot more opportunity to explore. Like I said, about 90,000% change in foreign direct investment. But then if you look at the same country and look at the percentage change in its GDP, over 30 years, it's only 138%. So despite a spike in foreign direct investment, there's not a corresponding spike in GDP. And that could be due to many different factors. One of those could be that foreign direct investment or GDP is not being accounted for as properly as it should. But even beyond that, it could be that foreign direct investment does not account for as much of the country's GDP as you would expect. It might be a small percentage of their GDP, and so the impact, no matter how big, is ultimately small. But that's kind of what this paper wanted to see. Well, if there's a change in FDI, is there a corresponding change in GDP? Is FDI inflow, an increase in FDI, particularly good for these countries, for these emerging economies?
Exactly. And I mean, and your home country as well, Ghana too. I saw
Yes,
the FDI was actually,
exactly.
I think it was second
About
highest then.
35,000%
Yeah,
change in FDI. But
yeah,
then change in GDP is about 300%. Um, so
yeah.
again, and again, if intuitively, that kind of makes sense. If you think of Ghana, for instance, FDI is great, but FDI is not the backbone of the economy. For a long time, for several
Yeah.
decades, and certainly throughout my upbringing, and even to this day, the backbone of Ghana's economy has been the single sector backbone has been agriculture.
Mm.
And a lot of the
Okay.
agriculture
Yeah.
in these places like Ghana is subsistence. And so it's really small scale farm,
Mm.
maybe a family that runs the farm, owns the farm, produces, sells, probably the government buys or some other agency buys the produce. And that's how it's been. And then maybe services industry. So um, if you have a country where foreign direct investment only accounts for just 2% or 1% of the economy of GDP, then even if FDI increases by 5,000%, that 2% can only grow so much to make an impact on overall GDP.
That makes sense. And I think, yeah, I mean, that's quite a very kind of explicit analysis of what you actually wrote in the paper. And I think that's a very logical argument to be made. Case in point, and I know in your conclusion you kind of wrote like the GDP. I mean, it's something I kind of read a line that you wrote. You said our analysis also reveals that although FDI tends to mimic economic growth, it is not distinctively the determinant of GDP, and it's difficult to establish a causal relationship. Can you just kind of extrapolate on that, because I think maybe that can give a sense of how you conclude
Yeah,
on the
certainly.
paper in general.
When we came to this conclusion, when we kind of were coming to this conclusion, it was initially a little disappointing because we were hoping to be able to say, yes, there is a strong relationship, or no, there is no relationship at all. Kind of like the punch to finish the paper, and we didn't quite have that punch. So that was a little disappointing. And I remember we talked with Lauren about it. Sort of when we're wrapping up our findings, and it actually was turned out not to be a bad thing. It just meant that there was not a causal relationship, and by causal relationship I mean that we couldn't establish from our analysis that FDI caused economic growth as measured by GDP. So what we did see was quite some correlation, and if you look at the charts for the different continents, you'll see that roughly FDI and GDP tend to, they trend in the same direction, roughly speaking, except for a few unusual times, like during the financial crisis, 07, 08, 09. But otherwise, they tend to move in the same direction. Right. So with that, we did see from the data, but what we could, like I said, what we couldn't conclude on was whether FDI was increases or decreases in FDI were indicative of economic performance in these emerging economies. And so that's when we say that FDI was not distinctively a determinant of GDP. That's what we mean. And so we were unable to establish a cause and effect relationship between the two factors.
Exactly. I mean, to be fair as well, I mean, you actually explicitly put that in, and in your recommendations as well, you actually gave some other methods to get a fair to kind of get a more solid result in some degree, or more kind of quantitative analysis. So I mean, it's very fair that in your recommendation you actually listed it out. And I mean, one line that I kind of stood out for me was that It's just a very first database. Following our data analysis and engagement of others' scholarly work on this topic, the authors have the following recommendations. And you kind of listed that, FDI inflow in the country highly depends on the host government's reputation. And I think that for that fact alone showcases that there's a lot of this. You can't really find some nuanced data that can help you justify or reject your hypothesis. So that was very interesting, and I think there was some other interesting recommendation that you provided moving forward. But I think your recommendation actually minimizes the element of uncertainty on what you listed out, and kind of give an indicator that there'll be more papers that can be written, more study that can be done. So, and I know for a fact that most of these scholarly papers, the conclusion doesn't have to be like a punch, because that might seem like, they kind of came to a conclusion before they actually did the paper. So I think that's fair. I think it's fair for what you did. But anything you want to say in terms of recommendation? And I know you said you want to you have some inclination of working this paper for the book. I think it would be a great idea.
Just a few thoughts. One, just also because you touched on this, and so I'd like to go back to it. One thing we touch on in the paper is regarding the causality of FDI on economic growth, and you tend to see from the data that the countries that have a strong or positive trend on economic growth, so the GDP tends to trend higher and higher year over year. They also tend to see an upward trend in FDI, and it makes you gets you thinking: is the relationship reversed? That is, do countries that have a stronger economy attract more FDI? And it's a bit of both. It's sort of a cycle. So if you have a country that's has a strong reputation as an economy, investors tend to find that as a stable environment, an attractive place to invest. And so what happens eventually is that they put money. It's viewed as less risky, and so they put more capital into those safer bets, those safer the safer opportunities. And so what ends up happening is that creates jobs, that increases productivity, and when productivity increases in the country, that drives GDP again. And so then, as GDP gets driven up, investors find it more attractive, and so they can come back and put more capital in there. Versus if you have a country that's not doing very well economically, no one wants to make the move to invest, and when no one makes the move, jobs are not created on the same scale. Productivity is not boosted as it can be, and so no one wants to invest. The economy doesn't thrive, and when the economy doesn't thrive very well comparatively, then even people don't want to invest even further. So then the cycle perpetuates. And I think that when that happens, the world misses out on certain unique opportunities that could be capitalized on because of the lack of because of the lack of awareness. And I think that data can help highlight that, or sort of help ease those fears. If proper research is done and there's a better understanding of the situations on the ground in some of these countries, then investors know what they're getting into. They know the unique country risks that they may face, and what the investment opportunities are, and how to mitigate some of the challenges that come with investing in these places. And as we overcome these challenges one at a time, economic growth will improve in these lagging countries. And then as economic growth improves, these countries then become more attractive, and then more investors can, sort of be drawn to these countries to put capital to work in these places. And that benefits everybody, because then investors, there's more certainty, more stability, so investors can generate more sustainable return. and jobs are created for the people in these countries, the economy thrives and everybody does better. That sounds like a utopia, but it's actually attainable, and I think that one role to play there is just transparency and data. So that brings me to recommendations. And you realize that the recommendation section of the paper is really, really short, because we just go straight to the point and say what we think could be helpful. And also because that was just not the focus of the paper particularly. The focus of the paper was to explore the relationship between FDI and economic growth. But one recommendation is that FDI, or foreign businesses entering countries, like I mentioned with the South Korean company in Mexico, has been shown through research not to be a threat to, a real threat to domestic businesses, especially for small scale businesses, unless you're seeing a dramatic takeover, sort of. And I wouldn't name any companies here, but I can't afford expensive lawyers. But unless you're seeing a very, very dramatic penetration of, very, very potent companies or institutions into countries that just cannot compete against these, because there are companies that, generate revenues well above even an entire country's output per year, so GDP. So unless you're seeing a lot of that in the country, it's been shown. And there's a paper by Telly in 2013 that shows that, particularly for retailers, the entrance of foreign businesses and foreign investment into local countries like India, it's actually not a threat at all to local businesses. So there is that, and so everyone, that should help alleviate some of the fears around allowing, international business in countries. And then the other thing that I talk about, this is specifically for countries in Africa, Africa could really benefit from a few things: technological infrastructure to facilitate the flow of information, but also the flow of goods and services, and people. I think that's sort of a bottleneck in African countries. And so again, there's a paper I referenced that I don't want to digress, sorry. But
sure.
So just technological framework and political stability are things that make a country more attractive for foreign investment, because no one likes political instability and uncertainty. Investors certainly don't like that. And so those are some of the recommendations that African leaders, but also really leaders of any of these emerging economies, if they really want to encourage foreign business and foreign investment, they want to sort of
build on trying to be transparent, help provide a climate for political democracy and fairness, and lack of nepotism and all that. I mean, this is quite an incredible paper. I know I'm being biased because but I definitely think the listeners will be able to be able to see after listening to this podcast, but also when they read the paper as well, and see how invaluable the content of the paper is, especially at such times as this, where emerging markets seem very favorable for investments, as you pointed clearly, and but on the caveat that the political climate has to be improved significantly. There have to be some technological advancement that will help mitigate some of the lack of just the reaching out to customers fairly, providing opportunities to non-consumption markets and stuff like that. But also the infrastructure development that you clearly mentioned that can help improve intra-trade within African countries, but also within the countries, right? So I do think this is really fascinating. I actually, really like the fact that this was the first episode because it's very academic, but at the same time it has a lot of applicable references as well as conclusions and recommendations that listeners will actually see the value of your paper, but also how emerging markets or emerging economies are quite attractive for investment, but as well as entrepreneurial opportunities. So
I also wanted to say
Kevin,
thank you for
thanks so much.
this unique opportunity. Like I said at the beginning, this is my first podcast experience. I'm really eager to hear what my voice sounds like. But no, beyond that, I think that this is
You'd be great, man.
This is a beautiful opportunity to sort of have conversations that really matter beyond the classroom, and so. Thank you for putting this together, and I'm really excited for where this podcast goes. And also I'm excited to have been the first guest on this podcast.
No, definitely. Thank you so much, man. And I would look forward to having you working more on this paper or something related to this as well. I think it'd be great to have you back at some point to talk about what you have learned so far, what you have done so far.
Absolutely.
In relation
Thank you very much.
So, thank you so much. And thanks everyone. Kevin Richardson, Masters of Science in Finance at Babson College. Many other attributes that we don't have time to mention, but he's such a great guy. So thank you guys for listening, and we'll have other guests coming up in the following episodes. Please follow up the episode. The podcast is called Time for Emerging Markets, and we look forward to having you in the next episode. Thanks again, Kevin. Yeah.